Joining us this morning, BofA Securities Head of U.S. Equity and Quant Research, Savita Subramanian, joins us. Savita, great to have you back. Good morning.
Great to be here, Carl. Thanks.
Walk me through sort of how you've been processing earnings season, the notion that there is some earnings momentum. We know there's some natural suppressants that could come during the summer in the form of the debt ceiling, but what is the most constructive you can be at this given moment?
Yeah, I think that what's interesting is that when you think about what we're all talking about and focused on, it's all of the bad stuff. So it's the idea that inflation hasn't been contained and the Fed might be forced to continue to hike. It's the fact that we're heading into this recession that we've been talking about for what feels like, many quarters now. I think what's interesting is when you look at the positioning of investors today, it's very similar to what we saw at market bottoms in 2009, 2020. Bond allocations are higher than they've been in 10 years. Stock allocations are lower than they've been since 2009. And this is based on our sell-side indicator, which is a gauge of how bullish or bearish Wall Street is. I've found it hard to find an unequivocally bullish client because we're all looking at everything going on and thinking rates just rose from 0 to 5 what in a very short period of time, and it feels like something else is going to break besides just what we've seen so far. I will tell you this, though. I think that what we've seen in earnings over the last few weeks, and we're waiting, this is another busy week of earnings, so we're going to wait till the end of this week to see what we hear. But what I find also very surprising and positive is that companies have actually been guiding up much more than they usually do. So just to quantify this, the guidance ratio, the number of companies guiding above versus below consensus expectations is now sitting at around 1.6. Normally it's below 1, it's at 0.8. So today, 60% or more companies are guiding above versus below, whereas normally companies are managing expectations lower. And I feel like that's another odd but very positive data point that suggests that, corporate America has managed a lot of these risks pretty aggressively. They've cost cut. They're not seeing as much of a demand destruction as everybody was expecting. And expectations might be too low rather than too high at this point.
Right. So does that make those who argued that there would be a reckoning on earnings actually somewhat in the near term? Does that thesis need to get a second look here? And as a second point, for the rest of the year, do earnings simply need to sort of just meet rather than blow it out of the water in order for some of the bears to come out of their holes?
Well, it's a good point. So I don't know if earnings just meeting expectations will be enough, but I feel like the market has been in this trading range for the last several quarters. I mean, our target is 4,000 and we've hit our target more times this year than I can remember in any other year. And I think that what's driving upside and downside for equities is positioning, is this sort of, 180-degree pivot from everything's okay to everything is awful. And right now we are more in that everything is awful camp. So I think that, depending on how long it takes for investors to get more comfortable with earnings and revise everything higher, maybe then we start to see disappointing earnings expectations. But here's our view. Okay, so here's the next 2 years. I think that we see a shallow earnings recession accompanied by a shallow economic recession, and that's what our economists are forecasting.
You call it recession light?
Recession light, exactly. And then next year, as long as we don't see sort of other hidden massive consequences of rates moving this quickly from 0 to 5, over the next 12 to 24 months, I think that we could actually be in a great, recovery year for earnings next year. We could see 10% earnings growth next year off of, very low levels. But I think, again, where I'm surprised and where I'm always surprised by corporates is in their ability to preserve margins against all odds. I mean, think about it. We've had the fastest move in inflation ever, and margins haven't really been decimated. So I think that that's the key to watch here.